Assalamualaikum warahmatullahi taala wabarakatuh, and hello to all of you. This is the lecture for chapter 6, investment basics and strategies in retirement planning. In this topic, we are going to look at the major characteristic of investment asset, life cycle investing, asset allocation, strategies in retirement planning, the concept, benefits and limitation of constant dollar cost averaging, and the application of constant dollar plan in lump sum investment, as well as we are going to look at the analysis on how we should choose our investment, which investment is actually better than another. As for the introduction, we can say that the personal investment is actually a combination of science and art in managing the investment of an individual. As we understand, the net financial resources actually referring to the difference between the value of the asset and the liabilities. Therefore, once we talk about investment, once we talk about how to improve the net financial resources of an individual, it means that we have to understand how to manage our asset, in the sense that we are going to increase our asset through investment, through other whatever mechanism that we are going to look at. And at the same time, we also have to well aware that we also have to control our liabilities, in the sense that we have to manage our liabilities and how to basically reduce our liabilities. And the focus is not just on asset, but also in managing the liabilities of the client. And this is a part of the main responsibility of the financial planner. The assets of the client, we can divide it into three main parts. The first one is the cash or cash equivalent. The second one is actually referring to the investment asset. And the third one is the personal use asset. When we look at the purpose of the investment, why we need to invest, the first one is basically to build the wealth and the security, because once we increase the wealth of the client, it will actually contribute to increase the economy in general. Secondly, is basically to leave a legacy, because if you have a lot of wealth, then you can pass this wealth for further generation, for your children, as well as for other people who are in need of your wealth. The third one is to cover for the decreases in the purchasing power. Over the time, we can understand that the value of the asset might be reduced due to high purchasing power. Therefore, we have to make an investment for us to increase the value of the asset to be matched, to be tally, or at least it can cover the cost of the purchasing power, so that our asset will be preserved over the long time. Alright, now we look at the types of investment vehicles for retirement. As we already know, the investment can be divided into two main parts. The first one is the physical investment, where we can referring it to the property, the real property, as well as any types of tangible asset. And the second types of investment is the financial assets, which includes securities as well as bank deposit. And for the purpose of retirement, we have to understand that as a financial planner, you have to be very conservative in choosing the investment for the retirement. This is because you are not supposed to invest in a financial instrument that are very risky, such as option and futures. This part of investment is actually very risky, and if the client lost the money, it will be very, very difficult situation for them. Therefore, as a financial planner, you have to be very, very conservative, because we are now talking about the retirement, where this money will be used to cover for the expenses and the cost of living of the client once they reach the old age, where they have no active income. Therefore, as for this part, we are going to look at the types of investment that are suitable for retirement purposes. Alright, some of the assets that are commonly earmarked for individual retirement, which includes life insurance scheme that are purposely for retirement, which means your client might have or might enroll or might attach to the life insurance scheme provided by the insurance company that for the purpose of saving for the retirement. The second one is the unit trust. You can also invest in the stock and shares, but at a reasonable amount, and at the the stock that might be quite stable, and it depends on the economic as well. And other asset might also real estate like property, and also we can use the life insurance policies as a part of the asset for the retirement, where in this life insurance policy the insurance company will give a cash value in the case where your client didn't claim for the life insurance itself. So you are entitled to get, or your client is entitled to get, some cash value. And this part, I think that we already explained about this in the in respect to the cash value information as in your financial planning report. When you are considering the investment vehicles for your client, there are several factors or important things that you have to consider, which includes you have to know what will be the required rate of return, where it should be obviously higher than the rate of inflation. Capital preservation, in case that your client actually wants to keep the money for the children, for example. So this is actually one of the things that you have to look at, that is based on the goal of your client. Tax effectiveness as well as the risk to be matched with the client's risk appetite. So if your client risk profile is high, then there are only certain investment that might be suitable for him. If, for example, he has a low acceptance of risk, then only certain, only specific number of vehicles or instruments that can be used for the purpose of investment for the retirement. Alright, so at this point of time, we're going to look at the unit trust, because this is one of the most suitable financial instruments, vehicles for the purpose of retirement. Unit trust is actually one of a very good investment for the purpose of retirement. Okay, so in case your client, they have a specific knowledge in buying stock and shares in the capital market in Bursa Malaysia, they can use that knowledge to make an investment. Nevertheless, if your client, if you yourself, for example, don't have a very good knowledge about investment in shares, that would be very risky. And the safe way for us to do this is by using unit trust, where you will make an investment to certain fund, and that fund will be managed by the fund manager. And the fund manager will invest the money in the stock market, and they are a group of expert users of the investment in the stock market, and hopefully by the knowledge that they have, the analysis that they perform, they can give a good profit to your investment. As you already know, in respect to the unit trust, there are many types of unit trust fund offered by the market. And you can see the banks are offering many types of unit trust to the client. So how you can choose the suitable unit trust for your client? We should look at the performance of the unit trust. And you also can refer to the ranking of the unit trust. Besides of looking at the performance, you also have to consider the objective of the client, because once you want to select the best unit trust fund for your client, not only just based on the performance, but also based on the objectives of the individuals or a client. For example, let's say your client prefer a Sharia fund, then you should focus on the Sharia fund, although the non-Sharia or the conventional fund seems to be very, very profitable. So your decision is not only based on the performance, but also on the preference or the objectives of your client. The performance of the unit trust fund is actually subject to the economy. In a good economy, in the bull market, once you buy the unit trust at a low price in the past, now it will give a high return. So it will make a good profits. But in a bad economy or the bear market, where like the situation is you buy high, sell low, so the unit trust fund also will suffer losses. So the performance is actually subject to the economy, and as we understand, the economy is up and down. As for this time being, during COVID-19 situation, this is a very, very difficult situation actually, and the economy is very, very uncertain, not only in this country but also all over the world. And at this point of time, we are not sure how long this will take place. Okay, one simple example, if you look at the economy in general, it depends a lot on the like our economy in Malaysia. One of our biggest resources is obviously the petroleum. And during this season, people are not allowed to go outside, so that's why the price of the oil reduced a lot. And countries that rely on the producing of the oil, such as Saudi, such as Qatar, they are actually rich countries, but due to COVID-19, their income has been reduced a lot. And if, for example, they have a lot of debt before, then they will not be able to cater for the expenses for their country and their people. Given that the unit trust is uncertain because of economic situation, sometimes the economy is good, sometimes it's not that good. Therefore, we need to have a strategy in the investment in unit trust, in the sense that we have to be consistent in our investment in the unit trust, so that during good situation we can make profit, and during bad situation at least it can be alleviated by the profit that we can get during good situation. Okay, because it is hard for us to predict when will be a good situation or when will be a bad situation. Therefore, if we are consistent with our investment for a specific time frame, then we can capture some of the advantages during the good time, and during bad time we still also can cater during the bad time using the profit that we have during a good time. Means that it's some kind of average situation. So this is a part of the strategy that we're going to look at. We call it as the constant dollar cost averaging concept. Now we are going to look at the constant dollar cost averaging concept. In this constant dollar cost averaging concept, we have to make an investment equally, okay, investing equal amount of money at regular interval, which means we have to invest an equal amount of an investment at a specific time frame. All right, so by using this strategy, it allows the average client to invest without having to worry when is the right time to invest. All right, so we are going to look at the example to see the demonstration of the effect of the constant dollar cost averaging concept on our investment. All right, now we're going to look at how to demonstrate the effects of constant dollar cost averaging to our investment. This is the example of the investment using the constant dollar cost averaging concept. where we have 5 investment period, and we invest the regular amount that is RM 600 per period, where this is the investment that we make regularly for each of the investment period that we have. All right, so now we have 5 period and 600 per period where we invested the money. And the situation is where the market is unpredictable or erratic, where we can see that the unit price is some kind like of fluctuating. Sometimes it is 30, sometimes it is 20. This is the price per unit of the investment. And we can see the unit acquired varied according to the price. So let's say we're looking at the first investment period. The amount that we invest is 600, and during this time the price per unit is 30, which means we using 600 investment we can only get 20 units, or we can only acquire we can only buy 20 units. So this is an unpredictable market where the price is fluctuating, and during this market, unpredictable market, we can see that the unit price, the total of the unit price is 130 and the unit acquired is 120. And we have to calculate the average price per period is about 26, while the average price per unit is 25. This is actually happened to us during unpredictable market. Nevertheless, during falling market, okay, if we consistent with our investment as well as our amount that we invest, we can see that in falling market, the price per unit seems to be reduced from 30 to 20 to 12 to 10, and the unit acquired also will be increased because the price per unit has been reduced. Okay, so units acquired get higher because price is low, so which means we can buy more units. Okay, so during falling market, we can see that the this is the price, average price per period is lower, that is only 18 ringgit and 40 cents, and the cost per unit, okay, the average cost per unit is also lower, that is just 15.79, which means during this time we can buy at the low price, but during a good time where the price increase, we can sell at higher price, or in a good market where the profit from the investment has been increased, we can make more profits from our investment. Okay, so during falling market, the rate of return normally very low, but during this time we can actually buy higher number of unit. All right, so during falling market, the rate of return from the investment normally low, but if we are consistent with our investment, we can buy more units during this bad economy. All right, and during the rising market where the rate of return is good, we can make profit because we have higher number of units that we get during the falling market. So in this situation, it seems that during a falling market or during a good market, we still can make something out of our investment. All right, so this is the example of rising market. We have the same investment period and regular amount of investment. We can see that the price goes higher from 12 to 24 to 30 to 40, and the unit acquired will be reduced. So we can see that the average of the unit price, average price per period is 25.2, and the average price per unit is 21.43. Okay, but obviously during the rising market, we understand that the rate of return normally higher, but the unit acquired is actually low during this time. Okay, so there are some advantages and disadvantages of each of the economic situation. That's why, for example, in the bad economy, situation, normally the suggestion is to buy shares at a low price, and during a good situation you can sell at higher price. Or for example, if someone having a lot of cash, normally during bad economy the property will drop, the price of the property will drop. If someone has a lot of cash, for example, they can buy the property at the low price, and during a good economy where the price of the property increase, then they can resell again and make a lot of profit from that. So bad economy doesn't mean it's totally bad, and good economy doesn't mean it is at all time good, because in the good economy where the price is normally high, then it is not really good to do the investment or to buy the investment during this time, because if we want to buy, for example, like in this situation, the price is high and the units acquired will be low.